I'm so pleased I get to sit on this chair. It's excellent. And such a fantastic speech, Faith. I think you've touched on so many really important things, and ultimately what we've seen from this week and also with the GFAN's announcement is I think that the willingness from the finance industry is there, even in an environment of uncertainty, in an environment where policies are not net zero 2050 aligned, that we are seeing commitments being made around net zero. So Barry, I was going to come to you first as an executive, chief executive, and influencing the board and setting climate ambitions within this uncertainty. What are some of the challenging conversations you've had to face, and how do you overcome them at that level of setting those ambitions?
Yeah, I think actually maybe I had it a little bit easier than my predecessors might have had in having these conversations, because I took on my role at Royal London at the end of 2019. And one of the first things we did was to establish some clarity about the corporate purpose. Now, this wasn't just Royal London that were doing that. I mean, there was a lot of discussion at the time about reinventing capitalism and establishing what the purpose of corporations was. But it was very, very timely from our perspective, and the climate emergency, or the need to take action on climate change, was obviously front of mind for the board and for the executive. But we ended up, happily it happened just before the first lockdown, but we ended up at the start of 2020 doing a session essentially with all colleagues that worked for Royal London, and about 2,000 people actively took part in sessions across the country contributing to the purpose. And one of the things that was coming through incredibly strongly was we're mutual, so we're owned by our customers and we're run for the benefit of our customers, which makes us a little bit different from a shareholder-owned company. But it also meant that colleagues felt very connected with the purpose, saw the connection with customers, and actually something Faith said resonated very much with me, because we were very focused on not helping people to accumulate pension funds to retire into a world that wasn't worth retiring into. You know, actually thinking about how do we help people maintain their standard of living in retirement, which is much wider than just the size of their pension fund. It's what sort of world are they going to live in? Are they going to have reliable sources of food? Are they going to be facing the sort of cataclysmic disasters that Faith was talking about? And I think that has worked, and that has meant that the challenge with the board and with the executive was maybe less than you might imagine. Everybody got there very, very quickly.
That's great, and I think a really important point we heard about fiduciary duty earlier, that it's not that needs to be redefined, not just financial return, but the world we will live in at that time, and that needs to be incorporated as well. Mm-hmm. David, as head of responsible investment at USS Investment Management, how was that journey for you? Can you provide us with a view on some of the drivers and the challenges for setting net zero related goals, and what discussions you had internally?
I mean, I think it's worth pointing out that climate change has been an issue that the USS as a scheme has been looking at for 20 years. We did our first work on it in 2001 and helped set up the IIGCC all those 20 years ago now. So climate change is not a new discussion point for USS. I think what the challenge for us was, how do we go from trying to address it internally to making that long-term commitment to be net zero? And from our side, building on that fiduciary duty point, how do you link that back to the financial performance of the scheme and make an argument that this is in the financial interests of our members and the scheme as a whole? And that's what we did. We worked with our internal financial analysts, we worked with our asset allocation team, we worked with our legal team to come up with those financial arguments so that we could have the discussion internally. And we had lots of discussions internally at various internal board levels, at the investment committee, and then finally at the board, because this is a board decision. They have to own this ambition to be net zero by 2050, if not before. So there was lots of challenge along the way to make sure that we had all the arguments laid out so that we could make that financial commitment to be net zero by 2050. And we did. What we haven't done at that point was work out exactly how we were going to get there. What we wanted to do was make a signal to the market, to our members, to the fund managers we have externally, to the companies and assets in which we invest, that this is the direction of travel that we know we have to go. And since our announcement in May, we've been working on setting up the structures internally, collecting the data sources that we need to measure our baseline and then measure where we're going, looking at how we change benchmarks to actually implement a net zero ambition. So it's not easy, but I think it's absolutely worth putting the work in, because we all know we have to achieve that net zero.
So you're kind of both saying that the boards are supportive of supporting, even though the how is not clear, to just demonstrate that willingness, and that is the core part of your goals. Yeah. So coming to the how, Barry, I'll come back to you. So setting those ambitions is a great first step. We also need to think about how we then incentivize investment managers to actually incorporate that into their thinking and investment decision making. So what do you have in plan to actually achieve putting your goals into practice?
Yeah, I mean, this is the difficult part. Everybody gets the conceptual aim that we're trying to achieve. And I think we're not going to do this alone. Actually, I was really encouraged by what the Minister said, because, you know, the tack that the Scottish Government appear to be taking, I think, is exactly right. This is going to require a collaboration that we probably haven't seen before between government, regulators and the industry. Because we have to create the proper incentives that make sure that people do the right thing. Now, what we're focusing on in the short term is almost waking customers up to the discussion and making sure that we have, from the demand side, customers demanding responsible investment, essentially. That action on climate change, we believe that we're good stewards of our money, of our customers' money. We actively engage with the companies that we invest in, and we want to create that demand pull from customers. So you'll probably see our advertising is very heavily focused in this area, but that's not going to be enough. We have to create an environment where the companies that provide the solutions do better than the companies that cause the problems. And although the Minister was mentioning the fact that ESG portfolios have done very well, and that is definitely true, I mean, some of that is as a result of tech stocks being almost systematically more sustainable, and tech has had a good run. So we do need to be careful that we don't read into that the job is done, because it's not. We're going to have to create a series of incentives by regulation and even legislation that means that it's easier and more profitable to invest in companies that are part of the solution than part of the problem.
And I think what is really key, and Faith mentioned this earlier as well, is that the goals support the transition in the real world, and not just in the portfolio, which you could achieve pretty quickly by selling out of carbon intensive companies. But to demonstrate that and to measure that, I think, is quite a challenge for the industry, including ourselves as asset managers. So maybe, David, coming to you and thinking about how do you demonstrate that you are actually influencing that transition to net zero in the real world? And obviously the challenges will be different across different asset classes. Yeah. Can you tell us more about that?
Yeah, I think the critical point here is we have to remember that it is a transition. And I like to quote one of the NGOs that talks to USS quite regularly. It's a transition, not a cliff edge. We have to go from where we are now to net zero by 2050. That doesn't mean we have to sell everything that's carbon heavy now, because it's a zero-sum game. If asset owners sell carbon heavy assets, someone else is buying them on the other side. Nobody else. It doesn't actually mean that you're changing the amount of emissions going to the atmosphere. You're just cleaning up what your portfolio looks like. And what we need to do is take the companies that we know are carbon heavy now and can transition, and encourage them to do so. And I think that's the key role of us as stewards of our assets in this transition, to be engaging with the companies and the other assets that we hold in our portfolios to make that transition. One of the key tools that we have at the moment, and a key collaboration, we talked about collaborations earlier, is the CA100+, which is a global collaboration supported by the IOGCC and other groups that pulls together investors, asset owners and asset managers to engage with the most heavy carbon emitting assets, listed companies around the world. And what we're doing is we're not only engaging with them, but we're measuring what they're doing. So there's a track of where they are, where they were, where they are now, and where they need to be net zero. And the Transition Pathway Initiative, which is a project which is measuring the how companies are transitioning along that path to net zero is part of the mechanism that's being used to assess that. So I think it's really important we focus on the fact we need to get from where we are to where we need to be and not just sell everything. I think another point is, for some sectors, it's really hard to transition. If you're cement, if you're steel, if you're air travel, the technology is not there yet to enable that to happen. So I think we need to think about system change, how the any producers and energy users can work together to make that transition. And I think there's a good example of how that can work. As I think it was September or October, BA flew from Heathrow to Glasgow on a net zero journey. But to do that, they had to work with air traffic control to reduce the amount of time the airplane was in the air. They had to work with Heathrow because they had to get the fuel from the fuel supplier, the oil company that was supplying the oil, work with the engine manufacturers to make sure that the engine could take the biofuels that was used. So you get a net zero flight. And obviously that's just a demonstration, but it just shows all the different players in the system have to work together to get there.
And so just staying with you to follow up on that, obviously measuring this progress in the transition, do we have the data and methodologies? We've got, I think, great frameworks, and the industry is working together to develop these. But do we have enough to set that clear baseline that targets can be monitored against and are comparable across the industry, or where do you see the biggest gaps and challenges?
I think the answer is yes and no. So yes, in that for quite a while now, there's been techniques and technologies in place to measure for public equities the carbon footprint of a company. So the Carbon Disclosure Project was again set up over 20 years ago, has been encouraging companies to provide data, and there are a number of service providers out there who've been collecting that data and enabling carbon footprints for public equities to be made available. And that can be stretched across to public debt. So, so credit can be assessed as well. But once you start moving away from those kind of public equity, public company type assets, to get carbon footprinting data is actually quite complicated. How do you carbon footprint sovereign debt? As asset owners, we are exposed to government debt, whether it's gilts or US treasuries or emerging market debt. How do you do a carbon footprint there? And then you get to your private markets, which are private equity, private debt, where there simply is very limited data. So when you're a pension fund trying to look at the carbon footprint for your whole scheme, you end up being really tilted towards the public market stuff. And that's not enough. That's 40% of our assets. If we're going to be net zero, we've got to get the other 60% across. So there's a lot of development that needs to be done in that carbon footprinting of all the assets that we have. And that's just the baseline. And hopefully we'll get there eventually. Then you've got to measure the transition. How do you measure how companies are doing? As I said before, we need to be focusing on those companies that can transition and pushing more those companies that either aren't willing to or can't. And therefore we need to know where they are on that transition route. And I mentioned the TPI, which feeds into the Transition Pathway Initiative, which feeds into the CA 100 plus assessments. So I think it's work in progress, but it's critical that we get that, because if we want to focus on and push companies that aren't transitioning, we need to know which ones they are, so that we can put more pressure on them as owners of these assets.
I think what's really important that we find a way of telling that story and demonstrating that, that this is about a transition. When some people might say, oh, well, that's just an excuse to keep holding certain things that are carbon intensive, and finding that right balance. And we've seen this week, Barry, maybe coming back to you, that the big 130 trillion announcements, which was similarly seen by some as great demonstration of willingness for the industry to be part of the journey, and by others as just an empty number of what does this actually mean in practice. So what was your view on that, on this big GFANS announcement, and what is really needed to make this a credible commitment with substance that gives people confidence that the finance industry wants to be part of that journey?
Yeah, I think there is value in the symbolism of the private sector committing in such a sort of a tangible and visible way. But there is a lot of work behind the scenes to figure out how do we actually put that money to work. So as well as my day job as Chief Executive of Royal London, I'm President of the Association of British Insurers, and we look after nearly £2 trillion worth of customer assets across our industry. And we are in active discussion. And I would say, first and foremost, you know, I sit on the climate change group of the ABI, and there is commitment right across the sector to making some real change here. But a lot of work actually happens behind the scenes trying to figure out how do we marry the requirement to hold enough capital so that we can meet all our liabilities in all reasonable circumstances, and these rules are set by the regulator. They were originally set in Europe, but they're adopted by the UK regulator here. How do we change those so that we can divert more of the industry's assets from traditional asset classes into assets that are actually going to solve some of the problems that we're facing in the future? What other regulation or what legislation might we need to encourage the transition from companies that are currently harming the planet? I mean, we obviously actively engage with these companies, the same as you do, David. And actually, one of the things that we're majoring on is making sure people have just transition plans. And again, it's not always about a quick transition. It's about a transition that lasts, because we do it in a fair and equitable way, and that means that we retain the consensus around the need for action, etc. So it is a very, very complicated issue. But I suppose what I'm encouraged by is the fact that government and the private sector are both sort of willing and able to work on this together. I think we do have some challenges making sure that all of the regulatory bodies that have different incentives are brought with us, but I think ultimately government can make that happen.
And I think that's a great segue to a final question for both of you, related to what we've seen at COP so far, because a lot of the net zero commitments of companies, of corporates in the finance industry are actually conditional on government policies aligning with net zero 2050 as well, and we're not there yet, as we know. And I think eventually this will be quite difficult to achieve decarbonisation in hard to abate sectors without the policy support. So we need to see more of that reflected in the NDCs. But a question for you, just in terms of what's your view on COP26 outcomes so far in terms of supporting net zero investors, and hopes for week 2 outcomes? David, I'll start with you.
Yeah, I'm going to get there in a roundabout way. I mean, I think it's important to realise that as big pension funds, we're something called a universal investor. We basically invest in everything, everywhere. If we have passive indexes, we literally invest in the entire market. So we're tied to how the market itself performs. So if there's a systemic risk, something that's going to impact the market as a whole, the global economy, like climate change does, then it will impact us. And I think that's important because when you look at things like implied temperature rise, which is one of the metrics that's being suggested that pension funds report to, we will currently, as universal investors, look like what the global economy looks like in terms of its implied temperature rise, which is not a pretty number. This isn't what the NDCs, the commitments of governments are making, which originally was putting us at 2.7 to 3.2 degrees, that kind of range. The positive that's come out of COP is now, with all the commitments being made, it was mentioned earlier, that's kind of 1.7 to 1.8 degrees. That's closer to the net zero, so that's really positive. But that's looking forward 30 years. The 2.7 was looking forward 30 years. We are nowhere near 2.7 at the moment. We're much higher than that. So if you look at an implied temperature rise for the globe, it's closing on 4 degrees at the moment. So it's that kind of thing. And if we're investing in everything everywhere, we'll all look like what the globe is going to look like. So that's why the 1.7 degree commitments are critical, because that's where we need to be, not where we are now. And I think focusing on where we are now will lead to some unintended decisions in terms of investments that we don't really want to make.
And I think now it's all about putting these pledges into credible actions, legally binding ones, so that we actually have some credibility behind there. Any final thoughts from you, Barry?
Yeah, I think, I mean, just reflecting on what David was saying, one of the things that we're much more of a retail business. In the asset management world, we deal with institutions, but a large part of our business is retail. And one of the messages that we've been sending to retail investors is don't underestimate the power of your pension pot. Everybody, as a result of workplace pensions, has a pension. And there was, Make My Money Matter, I think, have estimated that using your pension fund to invest differently can have 20 times more of an impact than recycling for the rest of your life or whatever. And trying to get some of these simple messages across that people have this power. One of the messages we have is this is no time to be passive, because what we're saying to customers is if you're passive, if you're buying the index, you're buying the good guys and the bad guys. And wouldn't you prefer to invest in just the good guys, or the bad guys who are trying to turn themselves into good guys? Yeah, and these sorts of simple messages are resonating, and people do want to do the right thing for the next generation. And so I do think, as a result of COP, one of the enduring legacies of COP, I think, is that we are leaving here with this sort of solidarity between the private sector finance industry and government on the need for change. And I don't think that's going to break down very easily. And I think we have raised public awareness of the issues and also some of the things that everybody can do to help.
I think that's a great point to end on for everyone to find out what their pensions are invested in and make a change through that. Thank you so much for a great panel discussion.
Thank you.
Thank you.